So welcome to this video. In this video, we are going to discuss about financial ratios. So financial ratios questions can come in a variety of sections. It can come in section A, B or C. So the questions can be as simple as a theory question, or it can also be a numerical question. It can also be a discussion oriented question where you have to think much more deeper than just the meaning of the ratio. So you have to indicate whether the ratio is higher is the better, lower is the better, or how a ratio would impact the company. So it can also come in a detailed manner also. So it is better if you have a thorough knowledge about the ratios. So in this video, we'll be like looking at a lot of ratios which are like covered in our syllabus. So we'll start with the profitability ratio. So ROC is a ratio where the formula is operating profit divided by capital employed. It's expressed in percentage, and the higher the better. So what does the ratio indicate? It is the return, that is the profitability that the investors will get for their capital employed. So it takes both the debit and equity capital both into account, and it tells how much the company is able to generate on that capital. So the next ratio is ROE. So this ratio works as profit after tax and the preference dividend. So what happens is it is divided by the share capital plus reserves. Okay, it's expressed in percentage. The higher is better. The profitability in percentage is compared to the equity shareholders funds. So how this ratio differs from this ratio is, here we only take the for the equity shareholders. So we don't consider the preference share capital or the debt. We consider only the return that is generated by the company for the equity shareholders for the capital that they have invested. That's why that profit is after tax and after the preference dividend. Okay, so that's about ROE. So we look at the some of the shareholder returns ratio. So the first ratio is EPS, earnings per share. So earnings per share is a better metric than just the net profit after tax and dividend. Why EPS is better is it also takes into account the number of shares as the denominator. So the numerator is profit after tax, interest and preference share dividends, and it is divided by the total number of ordinary shares in issue. So it better measure when than the profit alone, and it is expressed as an amount in per share value. The higher is better, and that is the meaning of the ratio here. So the higher the EPS, the higher the value for the shareholder. So the next ratio is PE ratio. So PE ratio is computed only after we compute the EPS. So it works like this. The P refers to the current market price of the company, and the E refers to the earnings per share. So it can work as a per share valuation or as a total value. For example, share price per share divided by earnings per share, that is EPS, or the market capitalization of a company divided by the total earnings of the company after tax. So this is usually represented in a ratio. For example, if the P is 10, we can tell it as 10x or 10 times. So it is actually a ratio. Or if you say 10, it is like for every 1 rupee of earnings, the price is 10 times higher. So whether higher is better or lower the better, it depends upon the individual company's context and also how the relative peer companies are traded. So we can't say higher is better or lower is better. It depends upon the context. So it indicates how expensive, okay, a share when compared to its earnings. So that's what the PE ratio is. So the next ratio is the total shareholder return ratio. So here what we do is we take D0 is the dividend that will be declared by the company in a year. P1 uh, is the price at the end of the holding period, and P0 is the price at the start of the holding period into 100. So what happens is here is assume that we have bought a share at 100 rupees. So the divider is also 100. And at the end of 1 year, the price has become 120. And we have also got a dividend of 10. So uh, we have got effectively 30% as the return. So that's what the ratio indicates. The higher the TSR, the better the it is for the shareholder. So that is about the total shareholder return ratio. So the next ratios which we will consider are the dividend ratios. So similar to EPS of a company, we can also use a DPS for a company. So DPS refers to the total ordinary dividend divided by the total number of shares issued by the company. Again, it's expressed in terms of amount. Higher is the better, and it also depends upon the context. If other competitors are giving a lower DPS, then our company also can have a lower DPS. If other competitors are giving higher DPS, our company also should have a higher DPS. So it is not about higher the better or lower the better. It depends again on the context. But usually investors prefer a higher DPS. So the next one is called as dividend cover ratio. So the formula is profit available for ordinary shareholders divided by the dividend for the company, which includes both the interim dividend plus the final dividend. It is expressed in terms of times. So what does this indicate? So assume that the profit available is 100 and the total number of dividend that is declared is 10. The answer is 10x. It means when compared to the dividend, the profit is 10 times is available. So the company is in a comfortable position to give dividend. Okay, so that's what it indicates. So the higher is better, and it indicates the sufficiency of profit to be declared as dividend. Assume the company usually declares 100 as dividend and the company has 100 as profit. In that case, it comes to 1x. It means that the company is in a very tight position to declare dividend, because even if the profit is going to fall to 90, then it won't be sufficient to pay the dividend. So the higher the better. So that's how dividend coverage ratio works. So the third one is called as dividend yield. So here what we do is we take the DPS as a numerator and we take the market price per share as the denominator. So it's expressed in percentage. You can also arrive at the same answer by using 1 by PE ratio. You will get the same answer. What it indicates as a percentage is, assume the company declares a dividend of 10 rupees and the market price per share is 100 rupees. So the company is giving 10% yield on the share price. Okay, so the higher the better. Usually the higher the better. Assume that if the share price is going to be 1000 rupees, then the dividend yield will be only like 1%. It won't be 10%, it will be 1%. So the investors will prefer a higher dividend yield from a company, but again it depends upon the context and the peer companies. If competitors are having a lower yield, then we can also have a lower yield. If competitors having a higher yield, we have to have a higher yield. So that's how it works. But also you can think like this: if a company has a lower dividend, then shareholders prefer to have a higher share price increase. Okay, so if dividend is lower, share price should at least increase in future. If dividend is higher, then investors feel that if even if share price doesn't go up, they don't much worry about it. Okay, so it's vice versa. Dividend and share price appreciation can be vice versa. Okay, and still investors can accept it. So we'll move on to the next ratio. The next ratio is interest yield ratio. This is a normal ratio that is being calculated. Interest divided by market value of debt. It's referred in percentage. The higher the interest, it's better for the investor. So that's about the interest yield ratio. So we'll move on to the next. We have a quiz now. So you can read this question by yourself and we'll try to find out the answer. So I'll read the question for you. Which of the following statement is not correct? Okay, so that's the key area. ROCE can be defined as profit before interest and tax divided by the sum of shareholders funds and prior capital charge. Okay, so prior capital charge means it's debt and preference share. Okay, so that's what they are indicating. But is the numerator correct? Profit before interest and tax? The answer is yes, this one seems to be correct. ROCE is the product of net profit margin and net asset turnover. You have to read this for much more detailed in Google. Okay, Google this. The answer is also correct. ROCE is a multiplication of both net profit margin and net asset turnover. So this is also correct. Dividend yield can be defined as dividend per share divided by the ex dividend share price. So this is also again correct. So we'll define ex dividend later, but for short term we'll put like this: the share price of a company after issuing the dividend. So that is what ex dividend share price. ROE can be defined as profit before interest and tax divided by shareholders fund. No, it's not a before, it's actually after. So this one is the incorrect one. So we'll see the answer. Answer is B. Okay, so this has come as a question in June 2015. So these are typical kind of questions that you can expect in a exam. So we'll move on to the next part of our video. In this video, we'll be like discussing about gearing ratios. So gearing is the amount of fixed expense and debt to finance in a company compared to the variable cost and equity finance. Okay, so we'll discuss about gearing a little bit in the next slide, but here we will just think about like this. Gearing refers to the fixed commitment that the company has. Okay, so it's a company has more fixed expenses when compared to variable cost. A company has more debt finance compared to equity finance. Okay, so if a company has a high fixed expense, it's gearing. If a company has a high debt finance, again it's a debt company. So these two gearing are like again classified into financial gearing and operational gearing. So if a company has more debt, it's financially geared. If a company has more fixed cost, it is operationally geared. So that's about the gearing. So financial gearing measures the degree to which an organization's activities are funded by borrowed funds as opposed to shareholders fund. Okay, very simply we can say like this: the debt of a company is higher than the equity of a company. If that is going to be happening, that is called as financial gearing. Okay, so financial risk. So it creates a lot of risk for a company. Ordinary shareholders might feel more risky because as the company is having more debt, the company itself as a whole has to pay a high amount of interest. Again, for them also it's very risky. For suppliers, they don't know when this company can become bankrupt, so they also feel risky. So financial gearing creates a lot of risk. So we find out the financial gearing risk. So we can find out gearing ratios. We can do debt equity ratio. We can do interest coverage ratio. So this is an example for financial gearing. Assume that this part of the question is a highly geared company. They are paying a high amount of interest. For 1 year, their profit is 100. Another year it's 50. Another year it's 150. When you are highly geared, you could not pay in certain part of the years. Okay, so this cannot be paid. So in those times, the company has to again borrow more money or sell off some assets to pay the interest. So that is a very risky position. This is a company where the gearing is low, so the debt is low and interest is low. The company can smoothly can cover their interest. So even if the profit goes to low as 50, still they can manage. So this picture shows you the difference between a highly geared company and a low geared company. So in what other ways we could compute the ratios for gearing? We can use prior charge capital divided by equity shares. So it works like this. It's so they have given you what is the prior charge capital. Preference shares, bonds, long-term loans, short-term loans, overdraft, all put together is prior charge capital divided by equity plus reserves. That's the denominator. So this is one way of computing the gearing formula. Or the second one is prior charge capital divided by total capital employed. So here it's like debit divided by equity plus debt. So earlier it was not that case. In earlier case it was like debt divided by equity. So in this formula it's debt divided by equity plus debt. Okay. So total capital employed is actually everything. Just ignore the current liabilities. So total asset minus current liabilities will give you the total capital employed. And prior charge capital refers to preference shares, bonds, long-term loans, all these stuff. So don't take the current liabilities into account. Okay, so that is not to be taken into account. So this is a second formula. Mostly in exams they will tell you whether you have to use this formula or you have to use this formula. Okay, they will also tell you the formula itself. They'll tell you this formula itself which you have to use, and you have to use appropriately. So the third formula works like this. Rather than finding through the balance sheet values, you can also use market values. So market value of debt divided by market value of equity plus market value of debt. Okay, so the market value of debt would be given, the market value of equity would be given. So market value of debt and again market value of preference share would be given. Okay, so your job is to just compute the numbers and give it. Okay, so that's how it works. So whether the higher is better or the lower is better, financial gearing, the lower is usually better. Okay, because it's like giving stability to the company, but still it depends on context. If competitors are highly borrowed, this company called can also borrow. If competitors are borrowing less, this company also has to borrow less. So it depends upon certain contexts. So here we can look at how the debt equity structure is for Indian companies. There are companies which are like heavily having a high amount of debt equity, or you can see through the ratios here. Okay, there is a company which is called as Suzlon. You can Google this company and get some information. So the orange is the net income and the blue is the net interest. Again, red is the net profit and the green is the total debt. If you can see their net profit, okay, their net profit is actually very low. Okay, it's very low. Some years it is even at a loss. But if you see their interest, there's no interest here, no interest. Interest is rising here, interest is rising, interest is rising, interest has gone up and up. If you see the debt, debt is like rising, it keeps on at a rising spree. So the company, what happens is the company has borrowed a lot of money and they are unable to even pay at some point of time interest, because here if you see the interest is higher than the profit, the blue is higher than the red numbers. So in these times the company has to borrow much more money and again pay the interest. So going for debt is sometimes is very dangerous, and that's what financial gearing tells you. And this is the share price of the company over for a period of 2008 to 2020. Look at the share price. This company has borrowed heavily. Their share price at one point of time was 400 rupees, but now it's at 2 rupees. So if you have borrowed and if you can't pay interest and your business is going bad, your company would be totally collapsed. So one of the way to analyze the dangerousness of interest and debt is to use interest coverage ratio. So the formula works like this: profit before interest and tax divided by interest. Okay, so what happens is if your profit is going to be 100 and your interest is 10, it gives you 10x. It means it's good. If your profit is 100 and your interest is going to be 200, the answer is 0.5x, then it's bad, because the rule is it should not be less than 3 times. Okay, it should not go less than 3 times. Okay, so that's the rule. So now we'll move to operational gearing. So operational gearing just indicates you how much of finance cost you have. Okay, so operational gearing is high when contribution is high compared to the PBIT. Okay, it indicates a high fixed cost, and thus a small change in sales turnover will have a greater percentage change in operating profit. We'll look at an example. So here in lower operational gearing, the contribution and the PBIT will be similar. It indicates lower fixed cost compared to variable cost, and hence a small change in sales turnover will have a less impact on the profit. We'll have an example so that it's easier to understand. You can look here. So if you take company A, their contribution is 100, their fixed cost is 25, their PBIT is 75, and their operational gearing is 1.3. Okay, but when you take company B, their fixed cost is higher. Okay, even though their contribution is same as A and B, their fixed cost is higher, their PBIT is lower, and the ratio goes for a higher. So that's what the previous slide also indicated. So in the previous slide it says operational gearing is high when contribution is high compared to PBIT. So we will just check. Okay, the company will have a high gearing when the contribution is higher when compared to the PBIT. Then we can say that the company is highly geared. Okay, so this number will be very high when compared to this number. Okay, so that's what it indicates. How can we compute the operational gearing in various ways? So usually it measures the business risk. So you can compute it in this way: contribution divided by PBIT, fixed cost by variable cost, fixed cost by total cost. Okay, change in EBIT divided by change in revenue. So memorize all these formulas. Any formula might come to you in your examination. So all formulas indicates the same thing. Higher the answer, okay, higher the answer for all of these or any of these indicates high operational gearing. So we can look at here in real world examples. For example, all these are Indian companies. Usually if you see, all of them have a common element. All of them are manufacturing companies, and mostly they are industrial manufacturing companies or very large scale manufacturing companies. So I think except for Tata Telecom, all of them are manufacturing companies here. Even Bharati Airtel is not a it's a manufacturing company. So we'll have an example like what would be the effect of this operational gearing. So we'll take ABB company itself as an example. So we'll have 2 years, year 1 and year 2. Sales is 100 here. In the next year it's 50. Okay, their variable cost is proportionately like 20% we'll take. So it will be 20 here, it will be 10 here. So they get a contribution of 80 here and a 40 here. Their fixed cost, okay, which is going to remain the same, okay, irrespective of sales happening or not, because they have a huge factory, huge salary they have to give, huge amount of laborers are there, they have to definitely give them salary. So that comes to around like 40. We'll take it as 40. Okay, here it's 40. So now what happens, the profit here becomes 0, but the profit here is again 40. So having fixed cost is a good way, but in certain times it acts bad. Whenever your sales drops, okay, your fixed cost will hurt you a lot, but when your sales is going to go higher, the same fixed cost will help you. For example, if you take for year 3, we'll just take it as year 3, sales is 500, so proportionately variable cost is like 20%, so we'll take it to 100. The contribution will come to 400, but fixed cost will always remain at 40. So they can easily make 360. They can easily make 360. So you can see here the proportion of its variable cost is always 20%. It's always 20%. It's always 20%. But if you take the fixed cost, it always remains the same. So the concept is, whenever the sales drops, the company will get hurt if it has a high fixed cost. But whenever the sales goes up, the same fixed cost remains constant, and it also helps the profit to get boosted. Okay, so that's how it works. Implication for a financial manager are as below. The financial manager has to ensure that the overall risk faced by the company is at an acceptable level. Okay, because all companies have operational gearing plus financial gearing. So there are like two parts, and a company which has both high, that leads to the overall gearing to be very high. The overall gearing will become very high. So the company has to balance it. So the financial manager has to find out a balance between the two gearings. It is a overall risk that will determine the rate of equity and investor demands. Okay, the higher the risk, then the higher the dividend and share price the company has to generate. Financial manager usually cannot change the operational gearing, so this part is out of question. We cannot change this. But what a financial manager can change is he can control the financial gearing. Okay, so a company which already has operational gearing highly should have lower financial gearing. Okay, so that's what he says here. The company with both high operational gearing and high financial gearing is likely to have high volatile earnings and EPS per share, or EPS. Okay, so both gearings should not be high for a company. Hence, companies with high operational gearing should have planned to have lower financial gearing. If this gearing is high, then reduce this gearing. If a company has a lower operational gearing, then those companies can go for a higher financial gearing. So it is vice versa between operational gearing and financial gearing. So we'll go through this question. Which one of the statements about a company with high operating gearing is true? A change in sales will have a relatively small impact on profit. It's high operating gearing. So this is wrong. The company has a relatively high proportion of finance debt. We are speaking about operational gearing, so we don't need to worry about finance. The company will have a higher risk and increased potential return. The answer is yes, it introduces more risk, but it also increases return. The company will have lower risk and decreased potential return. No, this is true for lower operating gearing. So the answer should be C, and the answer is C. So this is a past exam question where they have asked this question for a 3 mark. They ask you like what is the usefulness of debt and equity ratio in analyzing the risk of a company. So this is the only question they have asked in a discussion based question, but this topic can come in a lot of 2 marks. So thank you very much for watching this video. We'll meet in the next video.